Hey, Bill Lethman here for Money Evolution. In this video, I'm going to be going through a hypothetical case study to explore the impact of some of these recent tax law changes that we've just gotten here in the last few weeks, including the One Big Beautiful Bill Act. And we're going to be looking at two things specifically in this video. One, we're going to be looking at what this hypothetical client situation would have looked like had the current tax rates, or the Tax Cuts and Jobs Act rates, I should say, if they were left to expire as they were originally scheduled to do at the end of 2025. And then secondly, we're going to be looking at some of the changes that were brought about by the One Big Beautiful Bill Act and what that could mean for their individual tax situation. So the hypothetical clients that we're going to be using here are going to be Tim and Jill Mitchell, which I've used in a couple of other videos here. And they have $323,540 of taxable ordinary income. Now, we left out the discussions about long-term capital gains or dividend income and things like that. And we just focused on what is that income tax base income and what does that look like with these new tax packages that just came out. Now, remember, as we're going through and doing these hypothetical case studies, your situation may be different than this. You may have more income or less income. But a couple of things I want you to get out of today's video is one, we're going to start to recognize and see the functionality of how some of these different tax law changes are impacting somebody's tax situation. And then two, as we're going through this, we're going to be using a tool called eMoney, and it's the financial planning software that we use for our one-on-one financial plans as well as our retirement time machine program. If you want to learn more about those, we'll put some links down in the description below here. So you'll see exactly what kind of capabilities this software has here. So again, the tool we're using is eMoney, and this is into some of the tax reporting that we have here. And there's a lot of detail to this, but the quick answer to the original question that I brought up at the beginning of this video is what is that difference? Because as we are looking at the software today, it has not been updated with the One Big Beautiful Bill Act information and all the new tax legislation. They're working on it, and we expect to have that out very shortly here. So I wanted to jump in and do this video before they made the change, because what this is reflecting is the same thing that we've been working with for the last several years, and that is our current tax rates under the Tax Cuts and Jobs Act, with that sunset provision scheduled to be for 2026, when we're going to revert back to the old tax rates and tax rules with maybe some adjustments for inflation here. So when we look at this, we can see that this is going to be very detailed, and we have our regular federal income tax, and we can see for 2025 their taxable amount for federal income taxes is $40,544, and next year, assuming they basically have about the same amount of income, it's $44,603. So it's about $4,000 of an increase that they would have expected to see if those Tax Cuts and Jobs Act rates were just left to expire here. And we can even go in and get a lot more detail here. And let's talk about some of the changes that would have occurred had this tax rate expired and we went back to those old rules. And we can see that here in some of the detail. So again, our total taxable income for these first two lines here for 2025 and then 2026 is going to be, assuming that that rate had expired there, so we're within a couple $100 of the total income. We're going to have some deductions above the line is what that's called. And this for the Mitchells is going to be their 401k contributions. I think they're both in, hypothetically putting $30,000 each into their 401k, and then they're doing $5,000 into an HSA. So that all comes off above the line. And then we're going to have their adjusted gross income. So up to this point, we're still pretty even with that. So they're still within a couple $100 of that. $258,000 is their adjusted gross income. Now, if you remember, prior to the current tax rules, we used to have something called personal exemption. So you got an exemption for every person in your household. So that was typically yourself, and if you were married, that was your spouse, and if you had dependent children, you got deductions for them as well. And then the standard deduction was one of the big changes that they made with the Tax Cuts and Jobs Act, and that was essentially pretty much doubled from what it was in 2017 to what it became in 2018 there. And in exchange for that, they got rid of the exemptions but doubled the standard deduction. And what that led to was a much higher percentage of people that chose to take that standard deduction versus itemizing their deduction. So according to the IRS stats, it was about 30% of people used to itemize their deduction back in like 20 2017, and now as it is today, it's about 10%. So, so that simplified taxes for a lot of people here. And so if we go into this, we can even go layers and layers into this to really get into it. And as we're doing financial planning and really trying to understand all of the different moving pieces and Social Security and withdrawals from retirement accounts, and then planning out things like Roth conversions, having this level of detail is like very, very important, and it really gives us the tools to make really more well-informed decisions. So we can see, we kind of zoom in on this a little bit here. So there's a couple things that did change as a part of the Tax Cuts and Jobs Act, and one of those was a limit to something called the SALT deductions. That stood for state and local tax, and that was capped at $10,000. So for the Mitchells there, they're hitting that. In fact, for most people, if you have a decent house if you're paying property taxes, and especially if you live in a state that has income taxes like we do in Michigan, we pay 4.25% on our state income tax, and then even sales tax could be included in that as well. It's not hard to be over that $10,000 limit. So that was really one of the big catalysts that kept people from itemizing their deductions. So they were tapped out this year for $10,000. They do contribute a little bit to charity, but even with all of that, they still didn't have enough to beat the $30,000 standard deduction. So that's what they chose to do, and that's what you would do, because you're going to take the higher of that. They have a little bit of interest income, but their mortgage is being paid off, and you can see that. That kind of gives you a really good idea of the level of detail here, because inside the software, we actually have their mortgage, we have their principal balance, we have their payments that they're making for principal and interest, and the interest rate. And so it knows how much of that mortgage balance is being paid off each year. And so as that mortgage balance goes down, the amount of interest deductions that you are going to have is going to go down as well. And their mortgage is actually going to be paid off sometime in 2027, I believe here. So they're taking the standard deduction. And then if we did have the Tax Cuts and Jobs Act expire, we went back to those old rules, there would not be any cap on the state and local tax. So they have about almost $23,000 in those SALT deductions. Their charitable deductions would be eligible there, and then they do have that little bit of interest deduction. So that $27,000 would have been more than what the standard deduction was going to be, which would have been $16,000. So their tax deduction here would have given them a leg up on that. And if we go back to this other report and we look at what that looked like as far as taxable income, their taxable income for the expiration of the Tax Cuts and Jobs Act would have gone down from $228,000 to $220,000. Again, all other income is basically about the same. So I always say when we're looking at taxes and trying to understand how much we're really paying, there's two factors. One is what is our tax rate, and number two is how much of our income are we paying taxes on? How much of our income is subject to that tax? And so that has more to do with the deductions and different things we can take off of that taxable income there. But as we go through, because the tax tables have gone down as a result of the Tax Cuts and Jobs Act rate, and they were kept in place by the One Big Beautiful Bill Act, you have things like the 15% became the 12%. There was a 22% bracket in there that was in lieu of the 25% bracket. Then there was a 24% in lieu of the 28%. And something I've talked about in many other videos, that 24% bracket that we have now, and now has been made permanent by the One Big Beautiful Bill Act, that tax rate actually went about $100,000 into what used to be the 33% tax bracket. So that was really sort of the sweet spot. And that's where we've been talking about doing a lot of Roth conversions and things like that. And I'll be making some videos on that here soon as well, and probably waiting until the software gets updated so we can kind of show you what that looks like with all of this new tax legislation. And specifically what we want to do here is we're going to look at how it's impacting the Mitchells specifically here with these new changes as a part of this One Big Beautiful Bill Act. So a couple of things. So the standard deduction was actually changed as a part of the One Big Beautiful Bill Act. Even though we're over halfway through 2025, they did increase the standard deduction for this year from $30,000 to $31,500. And if you're a single filer, it's going to be half of that amount. And then they did increase the state and local tax cap from $10,000 to $40,000. And that's going to be whether you're single or married filing joint in either case. And then they made a couple of little changes to how you can deduct charitable contributions, and that's going to directly impact the Mitchells here. One of the things they did is they put a 0.5% or 0.5% floor as a part of your AGI. So that first 0.5% of your AGI is not going to be allowed as an itemized deduction. It's only going to be the amount that's going to be over that. So for the Mitchells, they are contributing $3,600 or deducting $3,600 for their charitable contributions. So we're going to take their AGI, $258,540. A 0.5% is $1,292. So when we look over here to their itemized deductions, they're going to be limited on that. So they're only going to be able to deduct $2,308 for those charitable deductions. The other parts of that are going to be the state and local tax, $22,806. So they're still well under that $40,000 cap. They do have some interest deductions of $2,467. So their total itemized deductions under the One Big Beautiful Bill Act would still be just $27,581, and it's going to still be far below that $31,500 that they're allowed. So they're going to take the standard deduction, and I think a lot of people are probably going to be in that boat, and it's still going to be a relatively small percentage of people that are itemizing, although that state and local tax increase to $40,000 will probably broaden that out a little bit over what it's been in the last couple of years here. Another change that they made to those charitable donations is they added in an above-the-line opportunity for you to deduct those charitable donations that you might be making there. And it's going to be $1,000 per person, so a married couple filing joint would actually get $2,000 that they could take as above-the-line deduction off of their adjusted gross income there. So their standard deduction, $31,500, plus that charitable amount that they could take gets their total standard deduction, if you will, with that charity in there, $33,500. So $258,540 of taxable income minus that deduction means that they're going to have $225,040 left to pay taxes on. When we run that through the tax table, they're going to be at $39,704 is going to be their total federal tax due. So when we look at this, we can see before the One Big Beautiful Bill Act, their tax would have been $40,544. After the One Big Beautiful Bill Act, that drops down to $39,704. So they're going to save an additional $840 on this year's tax return. So it kind of gets a little bit messy, and I appreciate you hanging in there and sticking around as I go through this tax math, which is not a very exciting topic, except it is when maybe you're saving some money on it. But this is all part of what we consider to be true tax planning as we're working through all of these different things that are part of your financial plan. Incidentally, if the Tax Cut and Jobs Act rates had expired, this is going to be an approximate tax savings, but the tax would have been $44,603. So it's going to save the Mitchells. This would have been if they had been left to expire the Tax Cuts and Jobs Act in 2026, they would have been looking at almost another $4,900 in additional tax. So thanks for sticking through the video with me as I go through all of that. We're going to do a couple more hypothetical case studies using some different people. We have other tax changes that were as a part of that One Big Beautiful Bill Act, things like the senior deductions, that extra $6,000 per eligible person over age 65. That was in lieu of the no tax on Social Security. If you're in that category where you're 65 or older, you or your spouse or both of you, there's going to be even some bigger tax savings that are going to occur here for 2025. And that extra senior bonus deduction is going to be in place just through 2025 through 2028. Hopefully it maybe gets extended, but that's what it is. So the next 4 years are going to give you a little bit lower taxation. And as we start to get the new models inside of our eMoney financial planning software, we'll be able to maybe use those extra tax deductions to do other tax planning things like doing Roth conversions, for example. Might broaden that out a little bit. And the nice thing is that you can actually take that senior bonus deduction, you're going to get that as an above-the-line deduction, so you don't have to itemize to get that, and you can do it whether or not you're actually collecting Social Security benefits or not. So hopefully you're getting a pretty good idea of what what the One Big Beautiful Bill Act might mean for you and your individual situation, and also learning a little bit about how our software, the tool that we're using to do our financial planning, and how we can use that tool to really dial in some of these tax decisions and strategies that you might be working on. And again, there's a lot of different moving pieces to this. So if you think about, maybe you've already tried some other retirement planning software that's out there, and I think a lot of it tends to oversimplify taxes and maybe just use an effective tax rate or a flat tax that is going to kind of carry through right now while you still might be working and into early retirement and even all the way through retirement. And so having something that can really be cash flow based, where all those different moving pieces are going to impact this tax situation. Everything from where you're contributing money right now, if you're still working, whether that's to traditional retirement accounts or to tax-free Roth accounts, and what it means for your current situation if you change that up, and then what it means later on as you start to withdraw that money and take distributions from those retirement accounts. And we have the ability to very quickly and easily map that all in and see what does that look like, not just in today in the short term, but what is that doing to your tax situation down the road. And really the only way to do this kind of tax planning is to have a piece of software and a tool like this that can really map that out. We can also get into things like Roth conversions and seeing when is the right time to do those Roth conversions, how much should you be doing, how do you pay the taxes on Roth conversions, and really, like I said, seeing what the long-term projections on that are. So anyway, thank you for sticking around through the video. I know we went through a lot of different detail here, and but again, hopefully you're getting that idea and sense of how exactly this stuff works. So don't forget to hit that like and subscribe button if you like the video, or share it with somebody if you think they can benefit from it. And if you'd like to learn more about the financial planning that we do, including our flagship program called the Retirement Time Machine, you can head to retirementtimemachine.com to learn more about that. We also have a higher level, more of a one-on-one, in-depth financial plan called the Money Evolution Plan. And that's going to be for people that maybe have a larger amount of net worth, higher income, maybe you have some executive compensation like stock options or restricted stock, deferred compensation, things like that, with a lot more moving pieces. That's going to be for that level. So anyway, check all that stuff out, and I'll look forward to seeing you back in one of our next videos. Thanks.